round of intro. Abhishek heads startups. Is the head of startup and venture capital at Google Cloud. Siddharth, founding partner, CFO, and ESG officer at 314 Capital. Please have a seat. Quick shout out and thanks to our friends at Google Cloud for supporting us and helping us put together this event. And everyone here, thanks again for joining us. We're all set to begin.
So apologies for the slight delay in starting this. I know Ida kind of announced that we are beginning and we took our own sweet while to come over here. But I hope the discussion is engaging enough to make up for it. So with that, Siddharth, let's go straight into the weeds, right? My first question to you, given your sort of, you wear dual hat of also aligning with the policymakers, apart from being the founding partner of 314 and being an investor. There's so much happening, right? I mean, over last few years, particularly in India, I mean, innovations like UPI, OCEN, account aggregator framework, right? And stricter data privacy that is kicking in. With all this, I think the market is ripening for more and more digital adoption, more and more sort of fintech, moving from the traditional BFSI to fintech sort of landscape. So with that, I would like to sort of ask you to share your thoughts around the market landscape, right? I mean, how you have seen it kind of shaping up over last decade or so. And
sure,
where is it right now?
That's actually a great question to start off with, because it gives you a very interesting overview of how fintech has actually evolved in India. Now, see, in the rest of the world, if you look at fintech has always been competition amongst private players who've actually ended up growing, scaling business models, and then the regulators slowly actually regulating with them, where the entire innovation stack has always been privatized to a very large extent, and the government actually creating guardrails. India is unique in the sense that the biggest fintech innovator in the country has actually been the government of India, and the Reserve Bank of India for that matter. If you actually look at the digital public goods that have been created around this as of now, UPI could have been a $100 billion company by itself. PayPal and everyone for that matter, which just enable peer-to-peer payments, not even to your bank account, mind you, but through an intermediary wallet, which is basically an accounting entry within the books of PayPal itself, with an additional $5 or some charge to end up actually transfer the money to your own bank account. You see an account aggregator where the ability to marshal information about your entire credit history and everything is now available to any single player to end up actually using. And because the costs have been flattened to such an extent, these normally end up being a few of 10 to 20 basis points, now it's actually as low as 4 rupees for any sort of credit check you want to end up running. Similarly, OCEN, ONDC, and the like itself. So we've actually seen India unique in the sense that what could have been billion-dollar enterprises by themselves have actually been subsumed, and the cost has actually been brought down to zero as of now. So India presents a very unique opportunity set to start building upon these digital public goods that have actually existing as of now. I think the biggest challenge, as well as the biggest opportunity set available, is how do you end up actually monetizing applications built upon this open playground that the government has. And indeed, even when we as an industry end up going and actually speaking to RBI, speaking to SEBI, speaking to Ministry of Finance, speaking to government, the one thing we always ask them is, as investors, okay, what is the next thing you guys in government are actually working on? So we know not to fund anything in that model until the digital rails have actually been laid out, for that matter. So there is a significant mindset shift that Indian entrepreneurs also need to end up having. And the mindset opportunity that exists over here is to make sure that you're aware of what the market landscape actually entails, for that matter. Now, a large amount of this work has actually been done by iSprit, and then actually moved to NPCI, and they actually end up putting a large number of position papers and the like. But I'm yet to actually find a fintech entrepreneur who actually does market research, not just by talking to his friends or his peer group, but actually inspects as to what the regulators, what are these larger market makers end up actually creating. So that fundamental gap that exists has actually caused people to make misinvestments into certain areas. I think one of the largest wallet companies in the country, I remember when UPI was actually coming about, vehemently fought and raised about $250 million to create their own parallel to UPI itself. They had to eat the entire cost because UPI actually UPI became fairly large, and now they become the strongest proponent of UPI across the entire country. Which is why when ONDCs come in, this large private player actually adopted ONDC wholeheartedly. I actually started sinking into that itself. So the biggest risk you end up running, according to everyone, if they ask in fintech, has always been regulatory risk. it isn't actually regulatory risk. I'll speak about regulatory risk in a little bit. Is the threat of the government actually democratizing and bringing down and creating a competitor that will always end up trumping what the private industry actually does. So the application says that you need to end up building upon this. The innovation that you can bring in is upon business models where you can actually charge the user for what is historically been given to them for free. UPI has been free, will always remain free to a very large extent. Even the largest chunk of the volume is always below 2,000 rupees or 2,500 rupees, if I'm not actually mistaken. It's only the larger volume transactions that may end up getting charged, but there'll be a very small percentage charge that ends up happening over there. So even the float income that used to exist for in the securities market also, by SEBI has now actually been bought down. But your entire float income has now evaporated. And we've seen a large number of brokers, their P&Ls have taken a severe hit. Even the change to the mutual fund TERs, for example, has actually eaten into the profit margins of what some of these guys have. So there is a shrinking profit pool that exists, and it's genuinely a threat that actually exists in the fintech landscape. But this actually feeds into what the government has always publicly articulated, that the only way India can actually succeed is to actually leapfrog some of the advances that other people actually have. We leapfrogged all the way from landlines to 3G to 4G for that matter. We've actually leapfrogged a large number of these innovative sets that actually exist. Even from banking as well, we're going from unbanked to digital banks becoming the norm, so digital bank accounts becoming the norm across the entire board. So I think that's one fundamental aspect that needs to be looked at a lot more clearly is what is the government actually doing and how do we keep aware of it? So that is number one. The second thing I believe that's also important in the market landscape is that there's this massive Kool-Aid drinking fallacy amongst the Indian fintech ecosystem where they genuinely believe they can actually replace a bank. So personally, I mean, it's fantastic branding material, the media loves it, etc. But I think one thing that's very important and needs to be publicly articulated a lot more. A bank is not just the sum of accepting deposits from customers, making sure they end up opening accounts and actually giving credit to other people. That's a very facile and narrow understanding of what a bank actually does. The banks play a very, very crucial role in money circulation as well as money generation. All of us are aware of what fractional banking reserves end up actually happening. And COVID was a perfect opportunity where rather than actually giving a direct stimulus check to every single person, the RBI actually pumped a large amount of money into the banks. And even though there was a transmission loss for a substantial period of time, that money ultimately made its way to every single person who's actually there. See, the most important thing to also understand over here is your banks are not just the sum of all the transactions they end up processing. Your banks are actually sinkholes of regulation. They are the most highly regulated person that's actually there in the entire country, next to, I would say, defense to a certain extent. So if something is actually that regulated, if you believe you can actually operate in this particular space and create a deemed fiction of saying I'm a technology company, I don't actually touch the money, it goes to something else, etc., that fundamental flawed assumption will actually end up hampering business models to a very large extent. And we have actually seen that played out in 2022. 2022, I remember June, well, I think by June 5th or June 7th, the RBI governor said we don't have plans of actually announcing regulations around neobanks as of now. We only will do digital banks through regulated banks and 75 digital banks, I think by August 15th or something, which actually did happen for that matter. And that's in the same month where they said loading credit onto prepaid cards isn't actually valid. You don't make sure that you do it from your own funds. Very large companies, mind you, in that space, who were issuing 3.5 to 4 lakh cards a month, saw the entire business evaporate because of one line that actually came in over there. We also saw a number of the companies who were doing FLDG and fintech lending and the like without having a license. We saw that entire the entire ground under them actually shift away. For a number of people in the industry, they looked at this and said, oh my God, the RBI is against fintech, they're against regulation, they don't understand what's happening, they're outdated, yada, yada, yada. That's completely and blatantly false. You're actually missing the woods from the trees when you end up making these kind of assumptions. The RBI has been one of the strongest proponents of fintech adoption and technology adoption across the entire world. No other bank in the country has insisted, no other regulator in the country has insisted that every one of their banks get onto core banking system. Such that UPI could actually end up being possible. IMPS could actually happen. So that all your regulations actually happen digitally. They can open these many number of accounts online itself. They are very strong proponents of that. But the one thing they've always done is, and it's a very simple thing, they said if you are dealing with money, you will be regulated. No matter what you do, no matter how you try, which fancy lawyer you go to, anything you do for that matter, they will regulate you. So the moment you have an assumption that I can actually enter this space and operate in this space without being regulated, your business will fail. You will be investors who will say no to those business models, and they'll be the smartest guys in the room who are sitting after that. And a number of investors, especially in fintech, and global investors as well, are still suffering from some of this, because of this lack of understanding, some of the Indian portfolio has actually taken a massive hit to that extent as well. Because even though everyone looks at fintech as a tech problem, fin is actually the most important element over there, for that matter. They say tech is an enabler. Tech is not the core business model that you have. The fin part actually becomes more important. And the moment if you think the fin part can be unregulated, you got another thing coming. Because I think the one thing as an industry should also learn, for that matter, is to actually analyze the history of the RBI and how fintech regulations have evolved in the country. When we actually got RBI was created in 1934, we actually got our independence about a few years after that, and we actually started. We saw a large number of runs on banks and bank failures in the 50s and 60s to a large extent. We saw large amounts getting decimated, thoroughly because of the fact they were unable to actually, the asset liability mismatches were actually large. The moment there were any issues, critical issues, especially on certain sectors like a famine or any major monsoon, we saw these banks actually getting evaporated. People's savings were lost when we didn't have an FDIC type mechanism. So the RBI has absorbed, and we've gone through the Harshad Mehta scam, this scam, so many scams, Nirav Modi, this, that, etc. All this is actually fed and has been fructified into the regulatory set that we see as of now. Even though everyone in this room will actually act honestly, act ethically, and everything for that matter, there exists a larger number of people who want to exploit regulations for what it is. And India has a 1.3 billion population, 1.4 as of now. We have a sort of fatal hubris as entrepreneurs and investors that our peer set actually represents the entire country. So what we end up doing is that what happens within Bangalore, what happens within Koramangala is very different from what happens just 50 kilometers away from Bangalore. What happens is far different compared to what happened anywhere else in the country. The level of financial literacy that we assume is fairly low, and our regulations are always created for the lowest common denominator. It is not meant for the sophisticated person who's there. They believe you're capable of doing it, handle it yourself, etc., take it up. Credit cards and having that OTP and that really wretched program right now, which is actually preventing people from actually having auto debits, happened because there were genuinely people who had debit cards and cards of the like who didn't understand what was actually happening on their statements. They were actually paying for charges they never actually assumed, which is why we have that kind of system that's actually come in now. So it's important to understand what the ground realities actually are and how the regulator actually ends up looking upon these things. It's going to a third point, which I believe is one of the things that actually helps you understand the market a lot better, which is to actually speak to the regulator. As this is one thing that's actually very disappointed in the Indian startup ecosystem, where if you have to deal with if you talk to any founder or the like, and you say there's something to do with regulation, something to do with law, something accounts, they're just like, don't talk to me, talk to my lawyer, talk to my big four guy, talk to my CFO, talk to my finance controller and the like. If you're the founder of the business, these risks ultimately actually land on your head. And the more, I would say, financially illiterate you are in these particular elements, the stronger the chance of you actually making a bad business decision that will actually sink your entire business to a large extent. And these are not interactions these are interactions that happen on a principal-to-principal basis. You cannot send a junior person, someone else, a lawyer, or some consultant of yours to actually go meet the regulator. They will never give you time of day. They will never tell you what's actually on your mind. And believe me, the regulators are very eager to listen to what's actually happening from startups. The reason why we suffer from bad policy in this country, to a large extent, it's a lack of dialogue between industry and the regulator. In the absence of dialogue, in the absence of someone going and expounding what it is that you actually do, what does the world actually end up doing in this regard, what are the safeguards that you need to put in place, what are the model set of regulations look like, and why it's important for them to adopt. These 5 simple points, they will listen to you, and they will actually call you as part of the committee. In fact, we actually have certain people here who were named by papers created by the regulator. Say, you came to us and asked us about this. We're going to put out a consultation paper, sit on the committee, help us decide what it is, and then end up taking it forward. The regulator doesn't read Twitter. I don't think they've ever given a damn about what was written on Twitter or Coup or social media or anything else for that matter. There's a very well-defined channel that exists. And the moment you start believing that noise actually ends up generating a signal, we are actually going to continue as a fintech industry, end up getting hammered by regulations we never actually saw. And that is actually the fatal flaw that's that. So any entrepreneur who can just navigate these 3 elements that exist, if you ask me, doesn't matter what your business model is, doesn't matter what you're actually going after. Just the fact that you're actually walking the straight and narrow will ensure that from a long-term horizon, you will actually end up compounding and the regulations will kill the rest of your competition. We've seen this happen in the fintech ecosystem now, where the unregulated entities now no longer exist. Those who had their business models flawed, finding it hard to end up actually bouncing back for that matter. And these were mitigable problems that could have actually been done. if you had asked the right questions and actually just followed the right protocol. So India will have the greatest amount of fintech innovation and build for the rest of the world. If the Valley built for the first 1 billion people coming online, over the first 1 billion bank accounts in the world, it'll actually be India and Bangalore that will build for the remaining 6 billion. They will build it at a fraction of the cost and multiples of the entire efficiency, for that matter. And they will build it in a way that actually respects local regulations wherever you operate. If you can do these three kind of things, in 15, 20 years, these will actually become as large as the banks, if not larger, and they won't end up actually competing with them. Like I said, banks have a different role. And we will end up getting regulated the same way. The greatest reward for becoming large in fintech is not actually a higher market cap or market valuation. It's greater regulation. The closer you end up understanding that, the more harshly they end up regulating you, the more valuable you are to the entire ecosystem. It's why they don't want you to fail. So I think internalize some of these elements. It'll actually hold you in very good stead as you go about your entire fintech journey.
Thanks, Siddharth. I think that there was a lot of new insights packed in over there. But trying to double click into this, right? And let's switch gears a little bit, right? So if you were to just sort of zoom out from India and look at the global fintech landscape, right? I mean, there are two kinds of fintech stories that have came out, right? And it is also a function of the regulation and the local sort of regulator versus banks versus fintech interplay. But there is a challenger model where you go out and you try to disrupt the existing scheme of things, very popular in some of the Western sort of regimes, versus in India, it's the collaborator model, which works better. And I think that understanding, sooner the founders get it, right, it's better for them. So with that particular sort of backdrop and with your sort of very active involvement with iSpirit and your engagement with various regulators, what's your perspective as it becomes practical for the founders to think through the market opportunities?
So one thing, even all the jurisdictions where they've had the challenger versus collaborative model, they've actually existed regulations for the challengers to end up coming under the same regulatory stack as what actually applies to the entities they are challenging. If you look at the UK, where they actually have Monzo and the like and neobanks itself, it is possible for a group of people to actually get together, create a banking license by themselves and actually start off a bank. It is not actually that hard from that perspective. You have about $10 to $15 million pounds of capital. It is possible for you to end up actually buying a bank, end up actually creating that and doing that. In India, I think the last bank that actually got a license was actually Kotak, and then IDFC First when it ended up, and IDFC Limited and Capital First when they end up actually, IDFC Bank and Capital First when they merged, they also got a license as well. And Bandhan also for that matter. So we had very few. In a decade, you'll have one or two end up actually coming out. Even if you look at the payment banks in India have historically been unable to actually operate because payment banks are primarily glorified wallets. A bank that can't lend is not a bank. It's a wallet. And a payment bank can't actually lend for that matter, which is why a number of them want to turn to SFBs. Every SFB wants to actually turn into a Schedule 1 commercial bank. The commercial banks want to actually end up becoming larger. So there is a path that exists in the rest of the world that is actually absent in India right now. And the reason why it's absent is, if you've seen the number of banks in the country since the 50s have actually reduced in number but increased in scale. Because what the regulator realizes, they have the ability that the economies of scale need to end up actually working in India for that matter. And unless we can't have too many small banks actually running around. So the capital adequacy ratios, management oversight becomes much tougher. So we've seen the range of aggregation that's happened. Now the thought process is actually shifting to say, because a large amount of it is actually digital and digital banks have actually come about, it is possible for India to end up actually increasing the number of banks that actually exist. Now, I can't think of a single entrepreneur or a person I know in from industry who's actually gone to them and actually given them this kind of analysis to say, India actually needs digital-only banks. And we need banks where they're not saddled with some of the other fitments that a normal regulated bank actually is. So your priority sector lending, making sure a certain portion of your portfolio goes to MSMEs, goes to farmers, goes to agriculture and the like. A smaller bank can't end up actually doing that for that matter because they'll never have the kind of capital adequacy buffer that may be required. But if you actually go to them and tell them, look, here's how I want to end up starting off, here's how a path ends up looking like, here's what we as an industry will do to adopt the best-in-class regulations from Indian banks and try to end up tailoring it to them. I think the first people who actually get together and do that, they will actually end up seeing a change. A digital bank requires no physical infrastructure. Banks previously used to get permission to open a branch account, to take a computer out of a branch account, for that matter. Now they don't even care about the number of, the branches aren't that important. You can create a digital bank, end up actually doing that. So for industry to end up adopting, we're still in the complementary set. I think that's fair to say. India will remain in the complementary set until the regulator believes that they are good enough people who are actually coming out and laying down guardrails that gives them the confidence to run these sort of little smaller lab projects and the like, these little experiments, and then actually put them onto the wider ecosystem market. Instead, what we've seen is people thinking of them as a challenger without actually being regulated, and they end up actually doing activities that are regulated, and then they have surprise Pikachu face when the regulator shuts them down. It doesn't actually work that way. We are not, even though the model in the US has always been move fast, break things, seek forgiveness later. I think towards the end of the 2020s, the US has actually broken everything that's there. They're now trying to rebuild. India looked at that and said, we're not going to allow anyone to break anything over here. Build if you have to, but build it slow. So you can't create a bank. Everyone who's created a bank till date, if you speak to the entrepreneurs, it's a 15, 20-year journey. It's not a 5-year journey in which they'll actually look at you, say, you're very nice, you're from this college, done this before, etc. Come in, we'll actually give you a banking license. There's not. That's why I said, understand the history part becomes important. So the challenger path is a path that the industry can actually move towards, provides the industry actually matures up and begins to actually actively engage. The moment you try being too clever by half, you will succeed in the short run. You'll have 1 or 2 years, you'll get a 100, 200, even $1 billion valuation at times. But when regulations catch up to you, even though hell had no fury like a woman scorned, I firmly believe that hell had no fury like the regulator abused in this country. And they will take you down very, very viciously. So saddle up. There is a very active opportunity set that exists, and we can actually become challengers. But the path to being a challenger is become an NBFC, become fairly larger, show that you can actually end up handling deposits. You have maturity in terms of ALM, that you can do what a bank actually does, or even certain aspects of it. Then they will have confidence and they'll allow you to do more. You'll become a deposit-taking NBFC. And now the top 10 deposit-taking NBFCs in the country are actually regulated as closely as banks. The next step is obviously going to be, we will convert them to banks, for that matter. There is a stepladder function that exists. You can leapfrog innovation. You can never leapfrog regulation. So have that in mind. Be as innovative as you can, for that matter, but respect that there is a path. If you want to accelerate that path, inspire confidence. The RBI, the sum total of, if you ask me, the sum total of all of the market caps of most of the Indian fintech companies doesn't equal to the quarterly profits of the top 10 banks in the country. SBI had a record quarter of 50,000 crores of profit. 50,000 crores is an exceptionally large amount. That's close to about $7.5 billion, or $6.5 to $7 billion for that matter. We've actually seen that amount of market cap wiped out in June when those regulations actually came about. RBI didn't bat or flinch an eyelid. So understand the scales in which you actually operate, and understand the path that actually exists. And make sure you meet investors and people who actually challenge the assumptions that you have and ask you the boring questions like this, so that you actually understand this. Fintech will always be a marathon. It'll always take years for it to actually end up changing. Look what happened to crypto in the US now. Once the SEC woke up, they just went after the two biggest guys. And they'll go out of their way to crush that industry, for that matter. Just because they said they didn't want it. If you want, actually the best example of seeing regulatory interface in the fintech space, it's an unfortunate example, was actually Sam Bankman-Fried. He spent most of his time outside of Cayman or Bahamas or wherever he had a nice pad, actually in Washington, working on regulations. Just to tell them this exists, here's how you regulate it, please regulate it. Obviously, he had different reasons for doing that, but you need to end up actually realizing that that model of engagement is extremely crucial.
Yeah, I mean, as you rightly said, right? I mean, being regulated is also a stamp of approval as well as a sense of legitimacy that you get, especially in the wake of depositors and the lender protection and those kind of things. And it's very interesting that you actually mentioned the issue of regulatory approval for opening branches, because personally I was part of a foreign bank, right? I mean, albeit on the investment banking side, but I've seen my bank struggle with each of these opening the retail branch, right? And you are seeing, I mean, what has happened to the foreign banking mandate over here. Yeah. But with that, let me sort of deep dive into a slightly related but a different point, right? By culture, the people who are building in fintech either come from fin or tech, right? And they have very different cultures, right? I mean, tech people have this entire thought process around don't seek permission, seek forgiveness when it comes to it, right? Versus as a fin guy, at least starting out a fin guy, Most of the fin people have this at the back of their mind that first let's check with the compliance and the regulations before building out anything, because you don't want to sort of unwind everything that you have put your heart, blood, and sweat into it, right? Apart from the VC money as well, of course. So with that perspective, how do you see, in terms of practicality, right? I mean, you mentioned sending lawyers, for example, right? So how should the founders approach regulators? What's the pathway? How should they establish this channel to sort of when they start building it?
No, that's actually a great question also, because the way I explained what you just said is, I said in fintech especially, the tech part believes everything is legal until stated illegal. If you're handling the fin domain, everything is illegal until it's stated legal. So I think that mindset shift becomes very important. It's why, like you said, you always seek permission. And which is also why in any regulated entity, the most powerful guy is not actually the chairman, it's not actually the founder, it's not actually the CEO. It's actually the compliance guy. The compliance guy, if he says no, I can't find till date the person who will actually stand up to the compliance guy and say, you're wrong, I'm going to overrule you. That will never happen. That's how strictly regulated they actually are. So unless you have someone within your team who can end up actually being a conscious keeper and to question these sort of assumptions, it may make fantastic business sense, honestly. But anything unregulated actually ends up making fantastic business sense. If you I have to ask all of you right now, if some bank actually just popped up over there, it's not registered with the RBI, is just taking deposits and the like, would you actually go to it? You'll obviously ask, is it a Schedule 1 bank? Is it actually registered? The reason why we see so many chit fund scams is these are unregulated. People have lost a large amount of money in being unregulated. So the cost of regulation is something that actually inspires confidence to a number of people. Even within the tech team also, even within a startup, there will always be healthy tension and sometimes unhealthy tension between the various teams who exist. Your engineering team will always look at it as a coding problem or a simple problem for me to actually end up solving. And they will have a solution. They will get immensely frustrated that the solution can't go live because there's someone else sitting in that organization saying, this runs afoul of this. That is a critical element. That's why the important thing is to actually understand what you end up doing. As a founder, educate yourself. Go to investors. When you actually talk to a fintech investor, and I keep stressing upon this often enough, don't ask him how much capital he can actually give you. The money that you get from a 314 to a SoftBank to an angel to a family friend, that amount will be the same. The color of money remains the same. It's the experience and that the person actually brings to the table to help you avoid these kind of mistakes that actually becomes crucial. Because these are the kind of things that you could actually end up avoiding. And even navigating the tension within it, you need to have a healthy appreciation of the arena in which you operate. If you believe this is all a mathematical problem or a logic problem to solve, you're unfortunately in the wrong industry. You need to actually look at it and understand the legacy that is actually fructified in the constraints that are actually placed upon you are as important as solutions you actually come out. Did you understand the ill of what they were actually trying to solve? If I were to ask you, I'll ask even a simple question. I'm going to tell you if you had to sign an agreement and I give you a choice of a blue pen or a black pen, which one would you choose? You'll be agnostic, right? You'll say, what sort of stupid question is that? If you sign a bank document, you can't use a black pen. Do you know why? Because they may actually say that your signature was actually Xeroxed. Even though color Xerox exists, and you'll have a great debate with the bank guy on that, this actually does exist. So these are not, the logic over there does exist within these entire fields. You need to ask for why the regulations are written the way they are. What is the mischief they are actually trying to rectify? What caused that mischief to precipitate? How do their regulations end up solving that mischief? How does that regulation end up impeding genuine innovation that's there? How do we end up ensuring that whatever change that we want combats the mischief that existed previously? Because the mischievous people exist all over the entire ecosystem, while ensuring that innovation is not genuinely stifled. So I think this is a sort of dichotomy you need to having. And when you speak to anyone in your organization also, if you're actually blind to why the regulations came out, just take it like this is the word of God that's actually come down from someone and actually translated onto paper, we never actually question these fundamental assumptions. Our rules are not permanent at all. Our rules actually change and adapt to market conditions. There is significant lag because there are market inefficiencies that prevent people from going to the regulator and telling them and giving them sufficient evidence for them to actually formulate a view. So from your team also, don't look at fintech as an engineering problem to solve. Look at it as a social issue to end up actually mediating and remediating. And once you actually have that lens and you understand how people can misuse the fundamental technology that you create, you understand why we have these kind of issues. Like when you add a new pay to your account, you can only transfer, I think, about 25,000 or 5,000, depending on the bank for that matter, for the first 24 hours. You'll say, why? It's my money, I can do what I want. But there have been cases where passwords have actually been leaked, people have added beneficiaries, and people have drained the entire account of what is there. Now, it may not happen to you. Hopefully, it'll never happen to you in your life. But it has happened before, which is why this actually come in. So the people who end up trying, you can create an account, we'll help you transfer any amount of money and try to bully a smaller bank to end up doing that. They will come down and they will crush you. We've seen large banks in the country also who've unfortunately given their license on tap to a number of fintech companies, been thoroughly abused by the RBI and actually all their powers being pulled out. So these are genuine market risks that actually exist within here. And so you need to sensitize your team to this entire part. Logically, it's very simple to end up solving payments for that matter in the rest of the world. I want to be able to send money from here till there. If the exchange rate is so much, let me actually do it. But the number of steps that exist in that entire transaction chain, what can actually go wrong for that matter, the complexities need to actually be understood by you. You can write the protocol, 100%. It'll have 99.9999 fidelity and all that for that matter. But that 0.001 chance that it actually goes wrong is what everyone actually over-indexes on. So the moment you start looking at it from this particular perspective, that is illegal until stated legal, how can I actually end up doing it? And be more patient. It is important. Your valuation will always outstrip value creation here. But your ability to create value is contingent on actually adhering to whatever Byzantine regulations apply. And if you don't agree with it, comply, then complain. Don't complain and ignore. Complain and ignore, you will die. There's nothing that can actually end up saving you there.
So I guess, three messages over here, right? One is obviously don't ignore regulations. Look at the compliance issues and engage proactively. The second is proactively engaged, but send principles rather than intermediaries, and regulators are open to sort of think through this. And third is, if you don't do 1 and 2, it will be a sledgehammer.
Yeah, you're in the wrong industry. Even the regulator part, right? Even when I've actually gone and met them, they've very often told me, don't talk to me about your investor issues, I don't care. What are the issues that startups actually face? They are very happy, but they want to talk to you. The moment you send a consultant, I put yourself in the regulator's shoes. The consultant may be representing X number of clients in certain ongoing live cases. Was to say that whatever the person tells that particular consultant won't be actually misconstrued and misapplied in a different case, but the context is actually different. And in India, where we have CBI inquiries, we have the Central Vigilance Commission and the like, any person actually saying that is genuinely at threat of actually losing his entire job. So it's easier for them to end up sitting. Inertia is actually the best defense in these kind of regards. But if that inertia becomes the default option, it's because now when the industry is actually playing it right. Go write to them. If not writing to them, reach out to your investors, reach out to industry bodies. There are enough people who would love to actually make that warm introduction to them. And genuinely go and tell them. You may have to wait 2-3 months, but there is a question of patience. I think the moment you end up doing that, you don't end up over-investing into an area that will suddenly end up actually collapsing. And like I said, if you don't do 1 and 2, just make sure you get a fairly large secondary when your valuation pops, because everything will go down to zero after.
Private conversations post this, but double-clicking on the market opportunity per se, right? While regulations is one part of it, but still you have to sort of go out and build, right? What are the spaces that you're most excited about, the pockets and the white spaces within fintech, where you think there's a large opportunity still to build out within fintech, and your perspective around those? Like, for example, what are the 2-3 ideas that you're looking forward for some founders to actually come and pitch to you?
No, happy to. I think, one of the areas I truly believe, and this is one of the largest profit pools that actually exists for a bank, and it's also one of the areas I've seen the least amount of innovation happen, is actually in terms of cross-border payments. It is one of the largest profit pools that actually exists in a bank, because cross-border payments are normally a function of large volumes and the ability to actually negotiate rates based on those large volumes. In Indian payments, I think it's fair to say you will never end up making money. That's for a rupee-to-rupee transaction, the RBI always believes it will be a zero cost or marginal MDR just to recover something for that matter above a certain threshold. But when it comes to international payments, it's actually free for all to end up actually doing it. And the international payment transaction chain is genuinely fraught with issues. It's still highly fragmented. There are multiple moving parts that actually exist. There are numerous documents that have to be given. There's numerous internal policies that you need to end up actually meeting. So if it is possible, like how they actually had bank account openings to end up expediting it before Aadhaar actually became the norm. And with the rise of the business Aadhaar that was actually announced in the previous budget itself, it is possible for a number of these KYC elements to actually end up getting mitigated away to a large extent. And the moment you understand the documentation required by the bank, as well as the purpose and what kind of transaction code it is, what are the normal set, what is required, it is possible for you to actually digitize a large amount of this. And if you aggregate payments, India, the education sector alone sends out about $15 to $20 billion outside the country. $15 to $20 billion going at even 0.5 to 1%. And there are times the forex charges markups are actually 1%, if not higher. That's a fairly large profit pool that actually exists for anyone to end up taking. And that's just one element. If you look at the overall amount that goes out through ODI and the like, there is a very large area to pay. Of course, this is highly regulated. You will never be able to supplant the AD1 banker. You'll have to work with the AD1 banker. You'll have to make sure you find someone who agrees to that. But these are very large things. And even the banks are the most eager for this kind of innovation because that's one of the largest profit pools that they have. And they said, if I can actually reduce my turnaround time, I can increase my volumes. I have a competitive advantage compared to the next bank that's there. I will have to actually do that. But we haven't actually seen, the only innovation we've seen there is people who want to invest overseas in the stock market through the entire thing, which has now unfortunately gotten plugged also to a large extent. So I think the forex pool that actually exists over there is a large opportunity. The second one, if you ask me, is actually going to be insurance and insurance penetration, not just being an insurance reseller or an insurance broker for that matter. We have actually seen IRDAI state that your health insurance or life insurance can actually be merged into one entity. We are looking for new players to come onto the insurance field and to just make the entire process of obtaining insurance easier. I think with the Orissa train tragedy case as well, a 0.35 rupee premium, which is a rounding off error, would have actually given you 10 lakhs worth of cover. More than 50% of the people who unfortunately passed away or were maimed in that accident actually lack insurance. And now the entire thing has actually been, how do we increase insurance penetration that's actually there? Which I think is a significant pool that actually exists for that matter. And insurance is slowly getting liberalized to a large extent, and they want more people to actually come in. Insurance penetration rates are still hideously low if you compare it to a developed world market like the US and everything for that matter. So that actually becomes two. The third thing I think is it's going to be harder to monetize, but it's a very large opportunity set that exists, is the inefficiencies in the subsidy chain that still exist and government programs as of now. Even though DBT has solved a number of the leakages that exist in that entire transaction chain, there are a number of government schemes that actually exist that are yet to actually map accurately to the beneficiaries that are there. Because they have bespoke requirements. I need this particular certificate in that format, in these kind of things. These are absurdly hard problems to end up actually solving because some of these documents don't exist. What are the additional documents that you may require? How do you end up actually processing it? How do you make sure the person's bona fide? How do you make sure the money goes to account, etc., and access it? This is a genuinely large issue because if you look at the entire payments bill of the country, outside of course, salaries, outside of pensions, outside of defense, our benefits end up taking a fairly large, and interest payments, of course, our benefits end up taking a fairly large chunk of their entire bit. And we're yet to actually receive 100% coverage. If you can actually solve for these kind of elements that are there for that matter, it is an invaluable service that you end up actually creating. So some of the basic elements, monetization models can include basic elements actually going out for free for that matter, whereas the other additional stuff, you can actually end up charging them a facilitation fee and the like. And mind you, there are offline people who charge very high facilitation fees for this. If you speak to any of your major drivers or someone and ask them what it takes, there is a large amount of cash that's going into the informal economy just to facilitate what is supposed to be the right of this individual to actually seek those particular benefits. So this is something, and any model that comes out over here, the government will be the first one to adopt it and evangelize it and actually push it to the rest of the country also. And the banks would actually genuinely love this because they have an allowance to end up actually making these kind of schemes work. They're yet to actually find anyone to end up actually doing that. So I think these are three things that come up to the top. Obviously, as you see GST penetration actually increase, even just factoring those particular invoices that are there, because credit is still a massive problem to end up getting solved. You can actually end up solving these. You can end up solving some of these because the Threads platform and everything actually exists. And I firmly believe at the end of the day, fintech is not going to be a vertical standalone industry by itself. Fintech is actually going to become horizontal. Cash management is a crucial element of every single business that exists, and fintech actually augments that. So ultimately, you will see, we've seen embedded finance and everything actually come about now. We will actually see fintech actually getting deeply embedded into the entire operating stack of every single company. Now, who can actually figure out that embedded fintech work and actually sit and collaborate with each and every one of these particular agents that actually exist over there and create a seamless kind of framework to allow them to do that, that would be key. Because your books of accounts of a company is a massive, rich repository of information that everyone's actually looking at. So you can sanitize that. You can assess the creditworthiness of the other person basis basically just checking it through an account aggregator or something for that matter, allow them to actually get credit through OCEN, directly actually pay that particular money to him. To actually take that invoice, basically the GST paid by that person, discount that particular invoice, get money immediately into your bank, or even become the clearinghouse for that. You will see fintech actually permeate every aspect of your lives. If you look at the essential elements of a super app also, it's always been communication, it's always been commerce, and it's always been cash. That cash in the transaction becomes an important part. So fintech is 1/3 of what it takes to build a fantastic super app. Commerce is now democratized because of ONDC. Chat is something that I think is still actually in the works right now. So these are the opportunity sets that exist. So these are businesses that can actually be built out, but you have to start small. And because you're dealing with, I would say, sensitive information as well as highly regulated information, any sort of misstep over there will actually end up being used. I know, regulation is the most boring thing to actually dedicate a good chunk of this to actually talk about. But regulations are a lot like personal hygiene. You do it well, no one notices. If you don't, nothing can possibly hide that stink.
Well, thanks to that. Some of those were very non-obvious ideas as well, and I'm sure founders over here have taken a note. One last question before we open it up for audience questions. I have been seeing a few hands up, but just bear with me for one last one. So next 10 years are going to be very, very exciting for India in general. With the growing economy, 10 billion or God knows how many trillion dollars we'll probably end up getting to. And financial inclusion being the way it is, that is going to be a large opportunity in any case, right? We are very underserved on credit and a lot of other things. So doing a little bit of crystal ball gazing with all your sort of experience right now, how do you see next 10 years for fintech in terms of landscape? How do you see it evolving? I mean, you have answered a few of those opportunity questions, but let's take a step into 10 years. How do you see this thing evolving?
So I think in the next 10 years, hello, yeah. I think in the next 10 years, so the next decade is going to be India's decade. I mean, people have been saying that since the early 2000s, but there's genuinely consensus now that the next 10 years is actually going to be India's decade. The US is actually still struggling with, am I in a recession, not in a recession, etc., and a whole bunch of other internal issues that actually exist. Canada is still struggling with population issues to get more people to end up coming in. Latin America has 100% inflation right now, which is it's actually absurd to end up thinking about for that matter. The whole of Southeast Asia actually fits in Uttar Pradesh. So Uttar Pradesh actually starts increasing its per capita income. It's a much better market to tap into as opposed to Southeast Asia. Australia is still a curiosity. The rest of the world is understanding and still trying to understand. Japan has been, unfortunately, in that kind of stalemate situation since I was born, which is more than 30 years ago for that matter. China is still now struggling. China will end up becoming older before it becomes richer. The Middle East is yet to actually develop a stronger cohesive market. And Africa is still fairly fragmented in the entire value chain. And the Eurozone just entered a crisis, entered a recession as of now. So India is one of the large growth engines, large material growth engines that exist in the world. And it's going to be Indian innovation that will end up actually creating the guardrails for the next. If you look at the advent of the internet and technology as well, the US actually leapfrogged the entire world. US actually created it, incubated it, got the biggest digital giants, and they took over the rest of the world. You don't have a Google in Europe, you have one SAP, but that's basically it, for that matter, right? And the rest of the world, you can't think of any of those internet giants. China is the other model where China allowed these large companies to come in, understood what they did, threw all of them out, incubated inside, became large enough, and then actually send them to the rest of the world through the BRI and everything else that's there. India, true to the Indian sense, is actually following a middle path as of now. We have the American model of a more or less free and open playground, but we also have some level of protection measures that China ends up happening. So this is the only place where an Indian startup will actually compete with the best that's actually coming from the rest of the world. And you genuinely have much tougher competition than what the rest of the world has, because Europe has failed to create the kind of unicorns that India actually has. India has far more unicorns than most of the guys, any of the European countries that actually exist for that matter. So there is a unique opportunity set. I think the next 10 years, what's going to be most important is actually the internationalization of the entire Indian fintech stack that exists for that matter. We will have, I think, with all the talk about alternate currencies, we'll start actually doing currency swaps to end up actually making that better. There is an immense amount of interest across the world in terms of digitization of bank accounts or transactions and the like, that the best model is actually the Indian model, where the playground's actually been set, digital public goods exist and they're controlled by the government, and private players can actually innovate upon the playground that's actually created. And India actually has a first mover advantage here, because every Indian fintech entrepreneur is comfortable and aware of what it takes to run AA, what it takes to actually log into the Aadhaar system, what it takes to actually run UPI and the like. the rest of the world is actually going to adopt something similar. Similar to how when the rest of the world started adopting the internet, they first moved on to Microsoft, they moved to Internet Explorer, then slowly came Chrome, and the entire thing happened. The default apps over here, when UPI and the rest actually goes international, is actually going to be Indian apps. The only question is, which Indian app is going to be allowed to do that? It may not be the banks. It'll be very hard for the banks to end up actually doing this. But in terms of payment enablement and the like, this is where the fintech companies can actually end up shining. And this is, I think, the greatest opportunity set that actually exists, because I think India is large enough. There are transactions across the entire world that happens. And if India is a test case, 76% of our GDP actually ends up going through digital transactions. Digital transactions are 76% of India's GDP. It's a fairly large amount. The rest of the world, I think, is in the 20s or the 30s for that matter. And thankfully, the rest of the world is now going to have an RBI to insist that all these charges become zero. So you will actually have monetization opportunities that do actually exist over there. But once again, when you do try to play a global fintech play, it's not just local regulation in India that you matter. It's actually regulations there. We've seen large international companies come to India, end up getting thrown out very viciously because they ran afoul of regulation. So I think the Indian ethos of respecting regulation and actually being beaten by regulation to such an extent gives us a fantastic advantage. When you go to another country, you will respect local regulations from day one. And you won't make really flippant statements the way a fairly prominent social media company before their acquisition actually did, saying that we don't care about the laws of your land, we are above the laws of your land. So I think if you have that, the internationalization opportunity of Indian fintech for the next 10 years will actually eclipse what e-commerce has actually been to India. Fintech is already the second or third largest attractor of capital on FDI into the country from a startup perspective. I think once you start going international, I don't think there's a single country in the world who doesn't want to adopt the low-cost payment that we have. And I think the first mover advantage should actually remain with Indians, provided that we actually get our act together and start actually acting as one and becoming more mature and engaging, such that when the doors open, we'll be among the first to actually get in. And that first mover advantage, I don't tell anyone in fintech, is one of the most crucial advantages you can end up having.
I mean, completely agree with you, especially the SWIFT, right? I mean, a lot of us are waiting for the internationalization of Indian fintech stack so that things become smoother. So with that, we'll open it up for to take some questions from the audience.
Hello. Hi, Siddharth. Thanks a lot for the insightful talk. I'm Raghav and I'm founder. So I really appreciate the amount of stress you put in for the founders to be in line with the regulations. But in many spaces, the regulators themselves haven't laid out regulations and how to operate. For example, the algorithmic trading space, that's the space I'm building in. So what should the founder do? Because competitors are operating. And you are not sure whether what you build will end up being valid or invalid in the eyes of regulator, because themselves, they have kept it in the gray area right now. So what advice would you give to founders in such spaces?
Engage. One word. Engage with the regulator. See, look, the financial markets, and SEBI is also a very strong regulator that way, even though they have a longer view. When they hit you, they don't hit you with a ton of bricks, they hit you with an entire apartment building, for that matter.
Right.
Okay. So even the guys who are running these illegal algo trades, etc., and the like, when the fines come in, they will not be able to even buy a mutual fund after SEBI is done with them.
Correct.
For that matter. So what you also need to do right now is, have you ever actually approached and written to them to say, look, I'm a startup in this particular sector, this is what I'm doing, here's what the regulations say, this is where they paused, I want to actually do this, please guide me on what regulations you have. Write to them, they will not respond to you. Write to them again, they will not respond. Write to someone else and ask for an introduction. There are enough fintech ecosystems, investors, and the like. There are enough good people in the industry who say, if this is a problem that's there, and especially investors, I want to invest in this, if this is a problem case, I can end up making money. They will take you with them to say, go and actually meet them, go talk to them. They are very, very receptive to that. So you go tell them that, look, this exists. Here's the way the rest of the world is doing it. Here's the guardrails that need to be there. Here's what people in the industry are unfortunately doing. These are the ramifications of it. Here's a good way of end up doing it. They will listen to you. They will then start a study. They will start a study, they will look at it, and they find someone actually taking any sort of panga with the law whatsoever, they will hit them very, very hard.
But many of the circulars are very open-ended. The founders themselves aren't sure about.
They are. But see, the thing is, if it's open-ended, it's a dialogue, right? You go and ask them once again. Like I said, they will not immediately in one day set out another circular.
Correct.
They will understand, they will spend time understanding the problem. Now, if you go there and actually do a market study, tell them this is what's happening, here are the issues your circular actually have. This is what's preventing innovation from actually coming into the market. And these are the guardrails that you have. Even for algorithmic trading and the like, the biggest problem that SEBI actually has with algorithmic trading is it's a fairly sophisticated product and ends up actually being fairly short-term trades using derivatives and the like. Because it's a sophisticated product, a person who invests into a mutual fund with 10 rupees, 100 rupees may not have the sophistication to understand a kind of product like this. So you can't have a product that ends up actually going to retail customers. The way to end up doing it, tell them, look, I want to do this. Allow me to create a kind of fund or something to end up a mechanism for this. Allow only accredited investors, where SEBI and then say acknowledge they are sophisticated enough and have a financial cushion to take these kind of risks. They'll say, fine. They'll let them. If a rich man wants to lose his money, I don't think there's any regulator in the country that actually prevent them from doing so. Let's be honest. But they want to prevent retail investors from actually getting in. So when your approach is actually factored in that way, and you go and tell them, it will take you a year, it will take you 2 years or something of the like. But when the regulations come about, even the guys who have that 2-year advantage will see their business model evaporate in one single line. Then everyone's down to zero.
Correct.
So that ends up actually being there. You cut a corner, if they ban you. See, the elephantine memory of our regulators is something that's highly underpaid. It's not just you pay a fine, they forget about you thereafter. You pay a fine, you're on a book. Something goes wrong, they know that these are the guys who end up taking actually liberties with the law. This is the greatest. It's like, even though we say past performance is not an indicator of future performance, past transgressions are a good indicator of future transgressions. So they end up going after you that way. It does take time. See, that's why you will build the code base and you will build the entire stack months before you end up actually getting regulatory clarity on what happens. That's why you need to actually do these simultaneously also. It's not a serial process. The moment you do it in parallel and have people from your team, even when you're starting off, to end up actually doing that, it will actually hold you in very good stead. We've actually seen, even though there are some companies now trying to take like deposits, etc., and say, I'll put money into an FD, this, that, etc., I'm a tech platform, end up actually doing it. You can't. You need to have some sort of license or regulation, either by SEBI or by RBI, to end up actually allowing you to do that. And they exist. Mind you, they actually exist. But if you run afoul of that, you will raise seed, you may raise Series A. Some guys even have raised Series C or Series D, but that's the last series you end up raising. So unless you get liquidity within that, you're going to see your paper gains actually get burnt in front of your eyes.
Yeah. So the thing is, to conclude this, so during this back and forth, you should be building simultaneously, but you need to have this dialogues with the...
Of course. It's a continuous, see, you have various teams with various focuses. You can't have the entire company going after that. As a founder, you're supposed to make sure that there's a team working on the engineering side, there's a team working on the regulation side, and a team working on every other part. And your job is to sit and marshal those resources and to make sure that your resource allocation, see, a founder at the end of the day actually does capital allocation. That's very important. You allocate capital to your teams in areas you believe will actually end up benefiting your business. So if you over-allocate to engineering and you under-allocate to the important elements of whether your business can go live or not, you'll have a fantastic-looking product that no one will actually use, which is the greatest tragedy if you ask me. Instead, if you notice in the market, we have fairly shitty products that everyone uses because they inverted it. They said, we'll consider the regulation part. The product is bad since we're the only 3 or 4 guys in the market, we'll end up actually dominating it.
Thanks to that.
Yeah, Siddharth, my name is Nagaraj. I'm the Chief Operating Officer and the Head of Fund Services for VRoot Global Fund Solutions. We are a fund accounting, fund administrator for the domestic and the international markets in the alternative investment space. My question is a follow-up of your answer, and thanks for the answer. It's going to probably help me in this question. Looking from a startup and looking at businesses, one side is their core competencies in terms of building solutions, coming up with innovative ideas and being able to address the requirement of the market. On the other hand, you have a back office support that is required. You need compliance as a service, regulatory reporting, regulatory monitoring as a service. You need investor reporting, inversion operations as a service. Do you think in this whole industry and for a benefit of providing a controlled environment to the startup and newer businesses, is outsourcing of all of these functions is an opportunity for this industry in the fintech market and other sectors in the startup and growing industries?
It is.
Thank you.
The joke in Indian investing actually is you have a 2-person investment team and a 6-person compliance team, for that matter. So given the fact that the largest cost center actually becomes your back-end operations and the like, it is a very large opportunity set to actually do. The AF industry in the country since September 30th, 2012, all the way to June 30th, 2022, has grown as a CAGR of 122%. I think the only thing that grew faster than that is actually EdTech valuations during 2020 to 2021, for that matter, right? So we've seen this kind of immense growth of that entire industry, and that full industry, I'm part of the industry, so I can say this with a lot of authority. The entire industry runs on two pieces of software, Tally and Excel. So there is a large opportunity set that actually exists that is yet to end up being tapped off in that extent. Now, to the operations, I wouldn't call them outsourcing. I would call it technology actually taking care of some of the more routine operations that are there to free up people from just actually pushing paper. I think that level of efficiency is a market opportunity that's actually waiting to be tapped, provided you understand the industry that's actually there. Now, even on the outsourcing part, there are unfortunately fairly strong circulars from banks and other areas where they can't end up outsourcing essential compliance functions to a third party, has to be in-house. But the technology tools that you end up building there can actually be can be gotten from a third-party service provider and build it by yourself. So with that efficiency you end up creating to your tech will actually be very, very important. But the flip side of that is one mistake in terms of your rule engine, those unintended consequences. I think your liability insurer will actually have a field day after that.
In fact, there are companies in the US who are building this out for the local regulations and finance workflows over there. But that remains a big opportunity that we are also very excited about.
If you notice, even in the Indian stock market right now, the best bet on the Indian finance play, if you ask me, isn't actually the banks. Look at all the other elements who are listed, who are part of the transaction chain of a person investing into securities. That's a yield business. They will always take a few basis points of every transaction. So when the transaction volume grows, their revenue will also grow. So it's so long as it is conform with the market, they're immediately growing as large as the market, and the fees will only increase. That's a fantastic investment play for you to also end up doing.
It's a market of basis points. Like it's a variable charge.
It's a small cuts of a very large pie.
Yeah.
That's actually easy to end up doing.
Thank you so much, Abhishek and Siddharth. To stay on schedule, next up we have our panel discussion. Inviting Sonal. Sonal is VP Investment at 314 Capital. Joining him will be Ajinkya, who is the founder of WindWealth, Ram, who is the founder of Hyperface, Anubhav, Rupify, and Sanket Digio. Please welcome them on stage. Can we have this water bottle changed as well and replace the glasses? I know it might be tricky to find your way, but
Hi everyone, great to have you all here. Inviting Sanket, Ram's here, and Ajinkya also on the stage, please. I work at 314, largely working on fintech and enterprise software investments. I'm here to talk to Ram, Anubhav, Sanket, and Ajinkya about a lot of things fintech. They've been seasoned founders in the fintech space, having spent over cumulatively maybe 25 years plus in the ecosystem. And we'll start with a quick round of introductions. Ram is the co-founder of JustPay and Hyperface now, one of our portfolio additions of 314 in the recent past. Anubhav was previously at companies like at Cubera, went on to found a company called Rupify. He'll tell you more about them when we do a round of intros. Sanket is the co-founder of Digio, and Ajinkya runs WindWealth. So let's get started with Ram. Ram,
Hi.
A couple of
Nice to
lines
meet
about where you're coming from, what keeps you inspired by fintech, and how you decided to start up again.
Right. So my first brush with fintech was in the year 2008, right? And it has since then it's been a crazy adventurous ride to see the digitization pan out in a big way, right? I still believe that the infrastructure and the financial services distribution and the reach is still not gotten to a point where we can call it like a saturation. Like for instance, in the US we have 650 million credit cards, but in India we only have 80 million credit cards, right? So the credit penetration and digital payments penetration itself is like, it's not gotten to a level where we can call it like say day one or day two, right? So it's still day one, and I'm so enthusiastic about building very fundamental infrastructure. That is what we're doing here at Hyperface as well. Thank you.
Over to you, Anubhav. Tell us something about your journey so far and the fact that you decided to start up again. What keeps you inspired to do Rupify?
Yeah, so I started in financial services same time, around 2008. But first 7 years was with large companies like American Express and Citibank as part of EXL. where I was mostly looking at the US market. Uh, but then as Indian fintech was heating up around 2014, 2015, is when I thought maybe that's time for me to start using some of their experience for the Indian context, getting to understand what's going on in the market. A lot of digitization was happening. Did something on the consumer fintech side, but slowly realized that there is a lot of activity happening on consumer fintech, and the incremental marginal innovation that can happen on the SME and B2B side is much more compared to the consumer side because of the uh, gradual process in which technology adoption has happened first on the consumer end and then on the SME side in India. That's what we are riding on, and that's what drives us. That how can we help take technology to the doorsteps of the very small businesses, not, and small business is a very loose term. A 2 crore or a 20 lakh turnover business is also a small business in India, and a 100 crore turnover business is also, as per the government of India, MSME definition is also a small business. So we want to split that, and we want to focus on the long tail because that's where the access is a problem. It's not customer experience, it's not product. The first thing is to provide them access and then solve in layers.
Thank you so much. Sanket, we were listening to some fun stories about how you got started. So tell us a bit more.
So my brush with financial services started sometime in 2010. And I don't think the fintech world existed, or in India at least. So I was part of the early team of the only startup credit bureau in India called Highmark. In fact, we were the only startup to receive a credit bureau license, and now it is Griff Highmark. Griff acquired us. I do not really understand a lot of things, and in fact, today also, DGO, I can't call ourselves a fintech company. Yes, we do have a significant exposure in terms of our clientele that happens to be from the financial services industry, be it RBI regulated, be it SEBI regulated, IRDAI, PFRDA, so on and so forth. But a personal liking for regulations, actually, like that's what my forte is. I understand genesis of regulations, why certain things exist the way it exists, and in fact, I was listening to Siddharth talking about the history, legacy of certain regulations and processes, and that's what I draw my expertise from, and I'm still learning. And so DGO as a company, can't really call it a fintech company, though we are regulated now under multiple lines of businesses. We are RBI regulated, we are regulated under the Ministry of Electronics and Information Technology, maybe sometime later by SEBI. So we are essentially an infrastructure company that has a significant exposure in terms of clientele and transactions in the financial services industry.
Ajinkya, you're one of the companies that got started just at the cusp of the pandemic, and you've had an eventful journey prior to this as well with M-Swipe and Credit Vidya and so on. So what got you and the other founders together to build Vint Wealth out? What is the wealth story that's playing out in India today?
Yeah, I mean, when we started Vint Wealth, our thesis was very bottoms up. We didn't think that we should start in fintech or anything. We said, here is what I understand is Indians have crazy obsession with fixed income products. If you offer them something 2-3% higher than FD, that will catch imagination and people will come, and maybe we can then cross sell, or we'll figure out. I mean, that was the idea, right? I mean, and that was the premise. And because I was working in fintech lending space, offering them bonds at 10-11% seemed like a good deal, and that's how we started. I mean, but we didn't have by then I had explored a bunch of ideas in different domains, so I didn't have particularly affinity ki fintech mein kuch karna hai. I'm glad that I started in fintech, right, in hindsight, but that was not them. It was like कि ये कुछ problem solve करते हैं, कुछ बनेगा.
Okay. Let's pick up one of these things which a lot of people have talked about, which is the when you get started, what companies have to think about. So that talked about the fin and the tech, what company awareness needs to be, and today there seems to be, to some extent, some fear around a lot of the things in the form of regulation changing and moving, and it's like quicksand. So let's start with Anubhav and talk about your experience so far from your time at working in the US and so on, coming back and applying what you know to India. What's that experience been like?
Yeah. So my first 2-3 years, I was part of American Express doing risk for small business cards, and this was in 2008 when another cycle was just happening. So a lot of that learning was more around controls. How do you build controls, especially in a bad economic scenario, as a credit company? Because it was a small business portfolio, it was behaving very differently, especially due to the mortgage crisis, exposures that small businesses had. US lenders and banks had taken multifold exposures on both individuals and small businesses. And one thing that I saw was there was a stark difference in terms of how credit penetration was compared to India in the US. So just to give some numbers, at that time in 2008-9, Amex used to have 3.5 million small business customers, unique customers with a credit card. We don't have that number in India today, after 15 years. That's the kind of gap we are talking about. Corporate cards exist, consumer cards exist, but small business card as a product does not exist. There are reasons behind it. It's not that India is 15 years behind. It's a different economy, it's a different segment altogether. But these were things that were fascinating me at that time. An average US consumer had like 12 credit cards in their wallet. That number is low single digits for India even today. And these are, I'm comparing numbers from that time to now. So consumer story was definitely fascinating. But when you look at small business side of things, I started asking questions. Why is it that we are so different? What makes India so different, especially on the SME side? And SMEs, they continue to drive 35 to 40% of India's GDP, employ almost 45% of Indian population, but the growth story of that contribution to GDP has been more or less stagnant. And one big factor is you need to pump in credit for them to grow. They need to have access to working capital, they need to have access to growth capital, and that's what is something that we thought we could build. Larger businesses, larger or medium-sized businesses, they still have options available in the market. But close to 50 to 60% of small businesses don't have any access to formal financial capital. And there are multiple challenges around it. The fundamental belief was technology can play a big role in solving those, because underwriting is difficult. Data does not exist in a very structured format. That is changing now. Collections is difficult because of the ticket sizes and the way Indian SME is structured and wired in terms of how they make their payments. And acquisition costs are generally higher because these are not entities which you can run some kind of a Google or Facebook ad and acquire. You have to go on ground. While they have a smartphone today and they have a low-cost internet, but in terms of trust towards a tech financial product, that's not there. So that was the challenge that we took up, that how can we create some kind of a roadmap, especially in terms of GTM, to solve this. And I think that's one of the driving force behind starting Rupify more on the B2B side for the small businesses.
Got it. So, similar thing playing out on the consumer side as well, where consumption is really what drives the economy. Credit has a lot to do with it. So, Ram, was that one of the reasons you were thinking about credit cards as a form factor? What's the personal credit kind of story that you've told us a lot about? Why don't you tell the audience as well?
Absolutely. See, the number of credit card holders in the country is probably about 4 crore, right? But the working population in the country is probably 10 times that, right? And the problem is that of how do we understand what is the earning capability and then underwrite these customers, right? That's always been the bane for a product like credit card. Another thing is that it's always seen as an elitist product, right? But it is the easiest product to actually take to customers in a very risk-free manner, right? And it also has the ability to actually get a customer to soft land into the credit network, right? With any other product, like building a credit history is itself very difficult, right? Like, why would I take a loan when I don't want, if I don't want? But when I want, I can't take a loan because I don't have a history of taking loan, right? And then it becomes a catch-22 situation, right? But with credit card, building that history becomes an easy thing, right? And the past few years, what it has taught us is that customers are okay to access financial services digitally at scale, right? I think the success of UPI goes on to show that, right? There is trust with regards to technology. For a common person. Right now, there is a lot of work that is being put into the ecosystem to actually get formal data also to formal institutions, right? I think that is going to unlock a lot of confidence for the banks to underwrite these customers, right? And which is why we believe that in just another 5 to 6 years, we should actually get to hundreds of millions of credit cards. Our goal is that we will get to 500 million credit cards by 2030, right? And that entire thing is going to be driven through digitization, right? Even today, if you look at the economics of issuing a credit card, it takes a bank anywhere between 3,000 to 5,000 rupees to issue one credit card, put that one credit card into the hands of the customer, right? Now, at that kind of cost, recovering that money becomes very difficult. But what if we could bring down that cost to, say, 30 rupees, right? And which is really possible today, thanks to the advent of tap and pay and virtual cards, and now with the ability to pay using UPI as well, right? So it really becomes a thrust for that. And once that issuance economics comes down, then the ability for banks to see profit within just, say, few months of issuing the card, that becomes a reality. And that will act as the catalyst for getting to that 500 million mark. Right? Otherwise, we couldn't have gotten, despite all the information being available, because the economics won't work out. Right? But with digital, the economics really, really works out in a big way. Right? And that's why we are so excited about this. And I believe that credit inclusion, for that, digital credit cards will play a very, very big role.
Let's go over to Ajinkya and talk more about the thing that powers all of these credit services. There are bonds, there is the financialization of savings story, or Indian household wealth story that is being talked about quite a bit. So tell us a little bit about that and how that plays into what you're building at Vint and the mission there.
Sure. I mean, these guys highlighted the credit card point, right? Like how credit is driving consumption. And I was looking at data. If you look at Nifty 50 companies, all the fintech companies are lending companies, right? And all the other ones are owner of D2C brands or FMCG brands. So in a way, it is either consumption or lending. And then we looked at deep dive into that data, that lending is also driving consumption. Only those are making it to it. So it's basically, on broad scale, it is a consumption story, right? But like, there are different Indias, right? India's Bharat, whatever. Like, there is this India 1, 2, 3, right? if you look at the net, I guess per capita GDP is about $2,300 or something, right? But if you look at the taxpayers' data, the top 25, 30 million have about, I would say, uh, 30,000 will be the per capita GDP, 20 to 30,000, right? So that's a completely different cohort from this, right? The consumption story is driven by them and them also, but these guys are still left with a lot of investable surplus, and that's our target segment, right? And people who basically pay tax in some way, in the direct tax and not GST, right? So, and their behavior is somewhat different, right? It's still not completely like a Western counterparts where there are a lot of social security in place. You have health insurance. If you get unemployed, the government will fund you. You have retirement corpus, etc., right? So this is, there are different terms, right? One of the term is Henry's, like high earning but not rich yet, right? So these are the guys who make money, but who are still like who haven't built wealth, right? So and there was one survey I was reading where it said about 70% Indians are one catastrophe away from poverty, whatever you earn, right? Like because you are like you are not insured well, you don't have enough savings, the government support is not there, which is normal at the stage of economy we are, right? So this, so what we realize, I mean, these people have started investing. So they want options that are relatively safe because they may not be completely okay with the volatility, right? And can we build that gap? Can we bridge that gap? And that's where we started playing on Win12, saying FDs don't actually beat inflation. Equity is not for everyone. And even if you, like, obviously, if you have to create wealth, there is no option than equity, right? But there is middle kind of position where people want to invest for short term in safer options, right? And that's what we started building at Win12, saying we'll offer you something that gives you 2-3% higher than FD. It will be definitely little riskier than FD, but it will not be as volatile or as risky as equities, right? And that was this. So what we are basically saying now, this all money should ideally go into like by rational asset allocations. We first will have emergency fund and then short-term goals, and then eventually for long-term investing you'll go into equities. But most of the people face a lot of problem while taking that journey, right? So, and that's why a lot of money is lying in savings bank account and FDs, right? Can you move it up, right? And that's what financialization of saving is. What we are saying is, can that, like, rationally it makes sense, right? From 3 to 6%, you will get 10% return. You obviously sign up for the risk, but that risk is can be well mitigated, well managed, well diversified, etc., right? And that's what we are playing on, saying, can we get people to understand this, and can they invest in it?
So Sanket, to tie all of this together, there's a lot of digital strings being pulled from in the background. We've seen e-sign, we've seen KYC, we've seen everything that's part of the India stack as well play a role. And Digio, to some extent, has called this early, got into business in 2016, and almost foresaw all of it coming. So tell us about the kind of services that you've been a big proponent of, and what else is to come, and how you see this digital part of it playing out, supporting all of these things on the credit side, on the investment side, on the other workflows on the saving side, and so on.
Sure. So, yeah, we are popularly called the India Stack company, right? Because whatever we have done so far is actually taking India Stack for consumption to the masses, right? There is the digital public goods, which is owned and operated by government public sector. How do you enable businesses to adopt it, right? So we are that enabler layer, and be it around digital identity management, digital documentation, digital signing, digital recurring payments, now with consented data, and going forward, there are a few more things that we have in pipeline, right? So we have built not only an application layer on top of the digital public goods layer, but also now getting doing vertical integration by getting into the deeper infrastructure layer. Because one of the biggest problems that we have experienced and learned over the past 7 years is the underlying infra is not reliable. There are no SLAs. When was the last time anyone got a SLA from a bank? When was the last time anyone got a SLA from one of the pseudo public sector companies for, say, verifying PAN or anything? They just randomly go down, right? There is no accountability, there is no answerability. If digital's services have to scale, and I'm not only talking of financial services, across healthcare, education, financial services, so on and so forth. The underlying infrastructure, A, has to be cost efficient, B, has to be reliable, and C, has to be predictable. Without this, things won't scale beyond a particular point. And customers will get frustrated, and they will go back to the physical way of doing things. So in fact, if you look at the entire thing around India Stack, right? How do you make the cost of service delivery cheaper? Because then only financial services can be distributed the way it is envisaged. Without making the cost of service delivery cheaper, you can't really achieve that scale. And problem being, the moment you make things cheaper, things break, because there will be cost cutting. So how do you really run a tightly managed shop? So we do not call ourselves a company. We call ourselves, we operate like a dukan, right? Very lean team, tightly coupled, keep costs under control, profits, big focus. Like we are like a very, very old school business, right? So, and keep being profitable, year after year, quarter on quarter, month on month. It's a long game. And once you keep building, accruing profits, then you are in a position to be slightly adventurous, but still no rash driving, slightly adventurous. Chalo, 80 speed limit hai, thoda 100 tak chale jate hain. And then pull back, right? And what we have also learned is, and I'm taking cues from what Siddharth was speaking about, regulations are the most fantastic things, yet the most boring things if you look at from that lens, right? Yes, we are all engineers, product managers, so-called tech bros and all those things, right? Reading a regulation, a policy document might sound boring, but if you love history, please read regulations. There is a lot of history in regulations. Like here, there are a lot of fintech founders, and especially from the lending side mostly. Very recently, I think last week, there is a RBI regulation on video KYC, right? The media has reported it wrong. People have interpreted it wrong. It's like DigiLocker, not accepted, CKYC, risky, this, that, video KYC mandatory. Can anyone tell me why? And first of all, how to understand this regulation? If you refer back to the Master Circular for KYC 2016 RBI, in person, so how has KYC really evolved? Earlier, it was an introducer-based system in banking, right? You couldn't just go ahead and open an account. You had to be introduced by someone who already has an account. If you do not have an account, the branch manager used to be that introducer. Then came the financial inclusion, the HR Khan Committee for Financial Inclusion. The whole concept of business correspondents came into picture, where business correspondents are essentially facilitating and also introducing the customer to the bank. Then, because identity was not solved for, then we immediately leapfrog to something like a biometric identity, right? Now, when things go remote, risks also increase. So more the risk, greater the checks and balances. When people were meeting with financial services providers across the counter, by default, that in-person verification was happening. Today, if you see, people are issuing loans, writing checks for 3 lakh, 5 lakh without even any in-person verification. So RBI had to come down saying that I have given you a VCIP mechanism. All of you cried that, okay, RBI is not, pro fintech, all that. They gave us VCIP when COVID hit us. How many people are really using it? No, none. Hardly anyone. Fintech KYC means selfie, DigiLocker kar liya, khatam. Because that is easy. But DigiLocker only is a substitute for your OVD process. You do not have to take a photocopy of an original and do an attestation. DigiLocker solves for that. It does not solve for in-person verification. Neither does a selfie really solve for in-person verification. So, yeah, just one example. I have lots more, but anyways.
So I want to go back to Ram, and one thing that you alluded to, Sanket, we've talked about collaborating with various entities, financial services and so on. Ajinkya also talked about this. So you've done this quite a bit at JustPay, where you've built services for other financial services institutions. You're continuing this at Hyperface as well. What has your experience been like working with these entities? What really moves the needle for them, and what kind of frame of mind and language do they talk? What gets through?
Okay, so it's very hard to brush everyone with one stroke, right? If you look at banks, right, working with banks is a very long process that requires a ton of patience, right? And it's it's very hard to understand how a bank functions, and different banks also will function differently, right? So that's very tough, right? But when we were actually working on the commerce side of the equation, right, that is very straightforward in terms of, let's say, their expectation of the predictability of the APIs, the latencies of the APIs, the stability requirements, scalability requirements. Those are all very, very easily jotted down and very easy to meet with, right? The benchmark always was like, okay, look, can you guys build APIs like Stripe, right? So that or like an AWS, right? So that no, this is for the commerce and the fintech companies, right? But when we work with banks, it's entirely different, right? Like, is your entire team coming under a certain policy framework for background checks and data loss prevention and a variety of measures that we need to take care of, right? So with financial institutions, the way to work is very different. We need to have a mindset of risk management, right? That comes first and foremost, right? Then comes the ability itself, right? So the safety first, and then the scalability, stability, and all of that will come later. Whereas with e-coms and fintechs, it's pretty much the other way around. The nature of enterprises is always that it's very frustrating because the decision cycle is always longer, like much longer than you desire. For instance, I come from Amazon, right? But that doesn't mean that I get a red carpet welcome for Amazon Indian commerce. It took us 2 years to convince, right? Even though the people who are deciding were former colleagues, right? Even then it was such a long, arduous process, right? So enterprise take a lot of time. So the mindset that is required is having a lot of patience and delivering on all these counts in terms of the technical area, domain expertise, right? But with financial institutions, in addition to all this comes the risk management, right? And they really worry about, will this business be alive tomorrow, right? Will they survive the next winter, right? So that's one place where a lot of convincing is required, which is why they take a lot of wait and watch approach, right? So these are some of the parameters.
Got it. So moving to you, Anubhav, I know we were talking earlier about what it takes to collaborate with the regulator. So that talked about consultation papers and working with expert committees. So I know you've also been part of some sandboxes and have that exposure there. So take us behind the scenes. What does that experience really look like? And what can fintech founders expect from the regulator, especially RBI?
Yeah, so I'll actually try to connect the dots from what Sanket was saying. So, you know, in my past startup, when we started working with banks and NBFCs both, one thing that came out is the biggest friction for any fintech in terms of new customer acquisition is doing that KYC bit, right? That's what nobody wants to really talk about. We just want to brush through it quickly and find the fastest way to do it. 2 clicks and get done with it. While speaking to like 4 or 5 different lenders, what I figured out is there is compliance, which RBI talks about, which is the master circular, and I think everybody should read it. It's a fantastic. It's not even a history book. I think it's a fairy tale. You know, when you go through that master circular, and they've done a very beautiful job in terms of starting from and where it started, what came next, and then what happened. So it gives you a turn of events as to how it has evolved. But yeah, so how I came to that master circular is that 5 different lenders had 5 different interpretations of KYC. This is compliant as per our compliance. And I was kind of flabbergasted with that there cannot be 5 different KYC interpretations. There has to be one. Either it is compliant or it's non-compliant. So what one NBFC was okay doing, another was not okay doing, and the bank was not okay doing both of them. So they had their own third requirement. So the first thing that when we went to solve for SMEs was I actually went and read the master circular and rolled out my interpretation on a blog in terms of what I think it means, and started getting people's thoughts as to is this compliant or not. In fact, the wish list, or for me, what was important is, can I get an RBI person in the room and say, am I correct or not, in terms of interpreting these guidelines? Because for individuals, it's still simpler. The moment you go to SMEs, that whole KYC thing becomes a laundry list. They ask you for multiple proofs of your business identity. If you are a proprietorship, then you are still sorted. But if you are a private limited company, then from the board resolution to your articles to your memorandum, and it just keeps going on and on. So that is when in 2019-20, RBI came up with this idea of sandbox. And they came up with the third sandbox. So the first sandbox was around payments. The second was around remittances. And the third sandbox that was announced was SME lending. And we were like, oh, this was open for us. So we jumped on it, applied for it. The process was quite contrary to what you would expect. So there was an RBI Fintech hub that they had created. And the idea behind the sandbox that they were running, the cohort. So this was the third cohort. So the idea behind this cohort was more like the summer internships that you have at colleges, where you get to do a project, but in some cases it's very close to a live working thing. So we went to RBI and we pitched quite audaciously. We said, we want to change the KYC norms for SMEs. It doesn't work. And they were like, tell us whatever you want to do in this sandbox, but don't touch KYC. We can take anything you want to do. You want to change how digital agreements are signed? We are happy to get you an entry into the sandbox to try that. You want to change how CPV is done? We are happy to look at that. KYC is untouchable. You can't try and test anything around KYC. So it was kind of a heartbreak for us, but then we were able to find other hypotheses we wanted to test, and they were quite open around it. And they created a structure where they asked you for a sample test that you will run. What are the KPIs on which you will measure your own success? So they let you define your own success criteria and keep monitoring that on a week-on-week basis. And they're quite active. So if, let's say, your sandbox starts on 1st and the week 1 ends on 8th, you dare not miss the deadline of sending them the report. Because 9th morning, you will get a call. Where is the report? So I think we had an interesting experience working in that sandbox in terms of getting a lot of inputs from them. They were ready to come on video calls. They were ready to ask a lot of questions. Every report we sent, they said, there is a bug in this, your data does not look right. So they were actually checking everything that we were sending. And it made us realize that, that there is a forum which we can access. And I think the 2-3 things that we wanted to try and test, barring KYC, of course, we were able to get through. And now we are in the final stage because we just presented the sandbox just ended. So we just presented the final findings to their committee. I see there is a window for fintechs to use this forum to ultimately go to RBI and say, this is why we think this X particular thing needs to change, and this particular clause in the circular, 50 different lenders interpret in 50 different ways. Can you come out with a clarity as to what this really means? Digital lending guidelines, I think, is one example where RBI has come out with FAQs and clarity on a fortnightly basis. They first came out with the guidelines, a lot of hue and cry in terms of what is allowed, what is not allowed. They gave a forum for startups and fintech founders and even regulated entities to come under one roof and give their thoughts. And then they came out with a clarity where I had 10 questions, 9 out of 10 I could find in their FAQs, which is phenomenal in my opinion.
So over to Ajinkya last, just talking about your brush with the other regulator, with SEBI, and what that journey was like. I know they've been quite collaborative, and you work closely with that interface. So I think one question founders typically have is, how should you read the regulator and work with them, interface with them? How to be proactive versus react? So you've had that experience fairly recently, so let's talk about that and what message you have for founders in the room.
I think a couple of learnings with the regulator is like when I generally talk to founders, and I also belong to that category, is we used to think that we understand customer better or the ecosystem better than the regulator. That's not the case, right? That we realize. And second, what regulators are generally worried, and that whenever somebody gets into entrepreneurship, whether it is VC backed or not, whether your greed will overtake your conscience, right? And that keeps happening, and especially we saw that happening a lot where before chasing growth or for some other reason, people started mis-selling, taking out loopholes, etc. And that's why we saw massive reaction in 2022, right? My broader understanding is even with the traditional entities, regulators understand there is some greed, and that is natural, right? But with startup ecosystem, I think they don't have that confidence that greed will be managed well internally, right? So that's why there is a lot of regulation coming in, right? Right. So that was number one. Second, if you go and talk to them, they are obviously listen really well. Yeah, we don't have much experience with RBI, but with SEBI, they actually came up with a consultation paper. They invited us. We presented. We asked for some things. They discussed it, and some of these things were actually implemented when the actual regulation came out, right? So that experience was great. But at the end of the day, you both are having different intentions, right? They want to protect the retail investors. You as a org, you might say or think and even genuinely want to protect investor, but how you look at that lens is very different, right? They are going to first protect the investor or the retail consumer, right, in case of lending. And then, so that is like a very, very ground rule, like that is a threshold for them. And then the innovation can happen. Right? While the fintechs think otherwise, कि innovation होगा, उसमें कुछ होगा तो फिर protection होना चाहिए, right? Regulator doesn't think that way. So, the best way we realize, and while working, and they're accommodative, SEBI definitely listens well. Many times they will not implement what you want. They will have their own reasons, right? And we still sometimes think that this should be done this way, but then but you have to understand that it's their job and it's their full-time job, and they're pretty competent, right? That's what we have realized, right? And you have to work with them. I mean, so and I see this often, and obviously we are panelists here, right? So those discussions are very formal. I've seen when people have drinks and the kind of conversation people have about regulator are very different, right? Right. But unless that view changes, I think there is not going to be reconciliation. Fintech entrepreneurs today even think that regulator ko nahi chamakta, right? And this is majority I'm speaking, right? And unless their view changes, there won't be any reconciliation. There will be never complete reconciliation, right? But I think as an industry, we will be better placed if we understand that well, right? In our case, like, we know we are very careful. We know we weren't regulated, but product we were doing were regulated, right? But there were some players who started bringing really risky bonds, 18, 19%, saying this is liquid, this is alternative to FD, you can park, right? And we were shit scared. I mean, and we knew that something is going to come, right? But we still today think, had that some players had not done that, would the regulation be more beneficial? I certainly think so, right? But if there are going to be people who act really rash, then the reaction of the regulator is also going to be like that, right? So we kind of felt it lucky that for us the regulation came in the right time. We had raised money, but we hadn't burnt it, right? So so we had a chance. In fact, when the regulation came, our business for like most of the metrics fell through 80% overnight, right? And not like we just went 1/5, right? But we're still happy because now we are coming back and the regulation is getting settled. Now our view is it is better to get regulated as fast as we can, right? And with SEBI, I think we have great comfort. With RBI, we don't have much experience, but with SEBI, we definitely have comfort that if you go to them, they will listen well, right? They will, and some of the initiatives that we did on the website, they actually prayed saying, we didn't expect any participant to do that, and you guys are doing it. It's a great work, right? So they also gave us some kind of pat on the back, right? So, like with SEBI, at least our experience is great, and generally it helps going and talking, right? Yeah.
Good. So on that note, lots of food for thought. But any questions from the audience? We can take a couple.
Hello. Yeah, thank you for the wonderful insights. I'm Daniel. I'm from Societe Generale, the European Bank. I have two questions, one for Ram and Anup, and one for Sankit. The first question is around the BNPL is evolving, right? Like while you talk about the credit card systems, and now, like, for example, Ola postpaid, every app coming up with their own postpaid wallets and BNPL, etc. Is it a threat, or how do you see as an opportunity or a threat for credit card ecosystem in a decade, how it evolves? And for Sankit, the question is around the data privacy and data monetization. Being a lot more digital that we continuously see, what is the opportunity in terms of the data monetization, and what are all the things that to be watchful in terms of the data privacy policy in India, etc.?
Great. Yeah. See, BNPL is good. Particularly the closed loop BNPL is fantastic because where the margins exist, there is a natural form of cushion to handle NPAs, right? And it's a soft way of getting the customers to come into the net. Again, like Ajinkya was saying, anyone that does it very rashly, that is where the problem comes, right? Where if it's phenomenally scaling and without any kind of a safety net, then there's going to be a lot of people marked as bad for credit. Right, that is a huge damage done to the ecosystem. If that doesn't happen, if this is happening in pockets, right, and if it is happening in lower scale from the institutions that are not regulated, I think that is still welcome, right? In participation with lenders, of course, that is still welcome. I see that as a positive change in the ecosystem.
But do you see it's continuously evolving and become a threat, or it's like continues stay in the cushion?
No, I think, see, it's still small credit, right? That is definitely beneficial, but the credit card, right, that is much more aspirational, right? And there is a lot of pull factor towards it, right? So it'll have its place, but it is not a threat to credit card, in my opinion.
Understood. Thank you.
Yeah. So coming to data privacy, I think data privacy, why are we just hearing it when things have gone digital? Where did data privacy exist when things were on paper, right? Data privacy as a principle should always exist, right? And one of the things that every financial institution will tell you, this is my data. No, sir, it is not your data. It's the customer's data. You are a custodian of that data, right? And thanks to the Data Empowerment and Privacy Act, we are actually seeing this law inverse, right? Like put the power of data in the hand of the consumer for the consumer to avail services at a better rate or whatever, and facilitate that transaction, right? By being data blind. In fact, if you look at the entire consented data architecture, right, like account aggregator. Account aggregator is not a concept only for financial data. Account aggregator is a concept for all forms of data which cuts across industries and use cases, right? It just that it is being rolled out, or it has been rolled out in financial services, with RBI being the regulatory body for financial services, right? So data privacy, data retention policy, purging policy, what data or things you should retain for what period of time, when it should purge it, who has the rights, user right, customer right, all those things should be thought through from day zero, right? There is no escaping that. Second, when it comes to data monetization, I am a fundamental believer that no one has the right to monetize their data unless the customer wants to use that data, for availing a particular service, and you are taking a cut from that transaction by facilitating that transaction, not by selling data, right? However, what you can absolutely look at data monetization is insights, right? For example, if you are into recurring payments and you have insight into systemic fraud happening, a customer takes a loan. Opening a bank account is super easy thanks to all the digital infrastructure we have. I open an account, I take a loan from lender A, I close down my account, mandate has bounced. I take the loan from lender B with a new account registered. If you are privy to this insight, this is invaluable insight before even a credit bureau gets this data. Credit bureaus get 90-day stale data or selective reporting, right? A bad customer is a bad customer for the entire system. It's a systemic risk. Please use such insights for monetization, not granular data. Signals, early warning signals. These are things that you should be looking at monetization, not by selling data for marketing, promotional campaign, all those things.
Thank you, Sangeet. This helps.
Good. So, any other questions? Great. So that brings us to the end of this event. Thanks to the panelists for joining us on the dais and talking about your journey so far. So we're heading downstairs for a mixer, so please join us downstairs. Thanks again for all of you for attending.